reasons. This is one of my newer stocks, BlackStone. And there is a reason. This isn't just because I wanted to go through them today and I've just happened on it, but I think it's a good bellwether for the stock market in general, and in particular, the a bit about growth being pulled forward and a little bit about how the investor mindset is going at the moment. Because overall, the headline that's coming out from Blackstone right now, even though it's 14% up on the week, by the way, earnings have dropped 41%, with JP Morgan actually expecting that they would go up and bringing on an overweight rating on that. So 41% earnings fall, but the market still likes it. Now, why does the market still like it? Well, it's all based on growth being pulled forward, but they didn't hire and they didn't make any excessive capex or investment to essentially make the same mistake that the big tech have done. So essentially they're seeing less investors invest in their company, invest in their REITs and in their funds, and that means they're getting less fees. They call it fee-related earnings, FRE, and these are significantly down based on last year, but simply because last year, or the year before at least, was excessively good. It's actually come down to exactly even better than where we left it, but it is showing that investors are now exiting the market, and they're exiting for the safer assets, basically. Particularly with BREIT, they got a lot of negative media coverage because they had to halt their withdrawals from their company, from their clients. They set it at 2%, and it obviously went over 2%. The CEO was very focused on that call, focused on the bad press leading to the share price fall, and stated that the media were wrong on this, and it's clearly been shown by Blackstone's share price recently. Assets under management were actually up 11%. Fees from assets under management went from 650 billion to 718 billion. So everything inside the company has actually gone up, even though it's showing this negative 40%, 41% in earnings. So there's really good stuff. And while it's a 5% withdrawals, that's not, which is another big headline that's going on at the moment. That's not net withdrawals, because actually inflows were still 43.1 billion. But overall, this is showing that investors are fleeing away from real estate, or at least private real estate, where they did very well, and maybe even flowing into REITs, or particularly less risky generated income like treasury bonds and things like that. So it's really showing what the market is sort of thinking about, and places like Blackstone and the other big investment fund companies like Vanguard and BlackRock, they're also showing a similar thing as well, but also not showing significant lack in fee generation right now. Nothing compared to previous years anyway.
It's always strange for me with private REITs. So they are the proverbial cinema where they can house 100 people, but if 100 people wanted to go to the exit at the same time, they can't. So you would think that when you're investing in something like a private REIT, you would sort of have that in mind, that if things are getting tough, you're probably not going to be able to get out. But that doesn't seem to have been the case with any of the private the big name private REITs that have a lot of assets under management. They must understand that the money that you invest into a private investment fund or REIT like this is going to buy properties, and properties can't be sold at the snap of a finger, and shouldn't be sold at the snap of a finger when things aren't going particularly well. So very strange investor behaviour for me, which is kind of like one of the reasons why you have to admire what Kathy has done, because she has managed to, coerce and confuse people who invest into the ARK fund. But the education on their part and the constant communication has kept people in a fund that, last year, if it was anyone else's fund, would have done a hell of a lot worse in outflows. But Steve, do you know Blackstone Group? I don't know a lot about them, so I'm kind of filling gaps here.
I know they go under the banner of kind of alternative investments, basically.
It's kind of what I know them for. My notes are very jumbled, so I couldn't. I'll watch that back later and notice that I just could not keep my head together because my notes were all over the place.
You would
In
watch
fact,
it.
no, I won't watch it. I've got halfway down my page the introduction to BlackStone, which says it's no alternative asset management company dealing in different segments like credit, hedge funds, real estate, and private equity. And actually, I had the 10K up in front of me, and it said, or a 10Q even, up in front of me, and it said that a lot of their earnings were fell from the hedge fund fee-related earnings. So that will be probably because in a hedge fund, you will have to pay your fee based on a performance rather than just a set fee. So maybe the performance wasn't very good in 2021 for the hedge funds, and that means they didn't get as many fees for that. It wasn't much. It was pretty much flat more than anything, but it will have lost a lot in fees because, again, hedge funds can charge a lot more fees for that performance.
One thing I do know about the BlackStone B-REIT, as it's called, is that their CEO was talking on the Barron Streetwise podcast the other weekend I was listening to. And one of the things he said is that where REITs have been struggling quite a bit because they're basically income animals and higher interest rates, it puts pressure on the returns that they offer. Blackstone's been doing pretty well because I think they are 90 or 95% hedged against higher interest rates. So they should be set to hold up fairly well as rates go up, where ordinary REITs tend to struggle a bit more, which makes me sort of surprised at the idea everyone's trying to squeeze out of a narrow cinema door here. That would seem to me to be part of the attraction.
Fund investors don't think like that, do they? They set and forget. They're not looking into the fund. They're not going, hey, we're alternatively hedged. It's simply, oh, I can get a better deal here, I'm going to go here instead, and that is basically it. But the two things that drew me to BlackStone in particular, just to leave you with, you know what? One bad thing, one good thing. One bad thing was the 1% dividend raise, and that is quite small for them, and it's quite small for a dividend raise in general. Shows that they might have a bit of a tentative view on the next year. But the other thing which shows they might have a tentative view, and which is a pretty good thing, is that they're dry powder, and we had a good discussion about this on the Discord with ISA Investor as to what dry powder actually meant. But their dry powder went from 181 billion to 186 billion. That means that they've got 186 billion essentially in cash. It is in short-term investments, but it is cash, and it's all generated from equity rather than credit, which is one of the theories that was out there. It looks like it's all from equity. So they've got 186 billion to spend on poor assets that are going badly during a recession. What's Berkshire Hathaway got at the minute?
In terms of dry powder?
Yeah.
Oh, I couldn't tell you. I thought it was 160 that I read last time. Yeah.
Yeah, I know KKR have got about 120 billion as well. They're the other Blackstone group. I noticed they've been going around Europe and hoovering up companies left, right, and centre. KKR at the moment. They're firmly on my too hard pile, but then I keep picking them up and saying, trying to get somebody in the Discord to research them for me, and I've been yet unsuccessful, but it might be one that I try and dig into myself, and by that I mean Google other people's breakdowns and read them.
It's an absolute nightmare going through every single sector and going through every single fund that they've got and seeing, right, how much they've got and how much they got allocated, what's the return. And I mean, I'm not saying I go through every single one individually, but I do look generally and go, okay, everything is on the up. That means more people, there's more inflows. 43 billion of inflows came in this year. That's pretty good. That's a lot of assets under management, and also a lot of fee-related earnings. So there's this positive there. I think they're going to make a lot of investments that are going to pay off in the very long term, obviously. 186 billion also means they've got a lot of liquidity just in case that narrow door gets a little bit narrower. And I think personally I liked it there. But I do think there's a tentative thing going over there. 14% up on the week since I bought it. So I got very lucky, I think, based on what I thought the negative news on the market had done to this company. Should really be selling it, to be honest with you, but no, we'll keep it. We'll see how it goes, and we'll keep that 4% dividend going and see what happens.